Hello there, everybody. My name is David Price, and thank you for joining me for today's video. We are going to be discussing foreclosure defenses, and specifically today we're going to be discussing the Truth in Lending Act and how you could possibly even get rescission, which involves the mortgage company actually paying you back the full amount of the loan. The premise here is that the entire mortgage industry is built upon constructive fraud. And if you know the right legal procedures and the right legal concepts, you are then empowered to go after them with the teeth of the law and demand remedy for them having defrauded you on a number of levels. So anyway, we're going to get right into today's defense number one, which is the Truth in Lending Act violations enabling rescission. And since I'm going to be reading directly, I am going to go ahead and open up a screen share so that you can watch along with some nice videos I found on log cabins and tree houses. So let's get that going. Okay. Okay, let's see if we can make this a little bigger for you. Okay, so jumping right back into this here. Let me enable also closed captions so you can read along here. And let's go back up to the first video in the playlist. Okay, and let's just go ahead and jump right into our subject for today. Truth in Lending Act violations enabling rescission. Defined, Congress enacted the Truth in Lending Act, or TILA, or TILA for short, to standardize the way credit is disclosed to consumers. TILA covers both closed-ended credit, like mortgages, and open-ended credit, like credit cards and home equity loans. And home equity loans. Before TILA, Truth in Lending Act, lenders could and did disclose finance charges on monthly, weekly, or daily basis, making credit appear cheaper than it really was. For example, a car dealership might have advertised financing at 1% per week and not include within that interest rate a list of fees that had to be paid at closing. Thus, 1% per week would turn into 52% annually, plus charges that might bring the actual cost of credit to 70% or more. Truth in Lending Act changed this by requiring credit offerers disclose finance charges in terms of an annual percentage rate, or APR. It also requires the finance charge be disclosed as a dollar figure, amongst a litany of other disclosures. Truth in Lending Act is federal law that covers most consumer credit transactions. The penalties for non-compliance can be stiff, including rescission of the loan transaction. Rescission means the entire mortgage transaction is unwound. All fees, closing costs, and down payment for the home is refunded to the homeowner. Additionally, all principal and interest payments are also refunded to the homeowner, putting the homeowner in the position he or she would have been if the loan never closed. This is great news, folks. Let me read that again. The penalties for noncompliance can be stiff, including rescission of the loan transaction. Rescission means the entire mortgage transaction is unwound, all fees, closing costs, and down payment for the home is refunded to the homeowner. Additionally, all principal and interest payments are also refunded to the homeowner, putting the homeowner in the position he or she would have been if the loan never closed. However, rescission is not available for loans used to purchase a property. Rescission is primarily available in refinances only. Rescission makes for a good incentive for lenders to comply with this regulation. Truth in Lending Act has many parts to it, and we will focus on 4. This defense, number 1, and the next are devoted to accurate presentation of the finance charges under Regulation Z of the Truth in Lending Act, because these violations are the most common. The following chapters discuss the Truth in Lending Act required disclosures, notice of rescission in refinances, and high-cost loans under the Home Ownership Equity Protection Act, or HOEPA. Truth in Lending Act, or TILA, T-I-L-A, is remedial legislation designed for consumers to correct lender errors after the transaction is consummated. When there is a dispute about whether an action rises to a violation, Truth in Lending Act requires that the law be interpreted in favor of the consumer. Liability will flow from even minute deviations from requirements of the statute. Again, Truth in Lending Act is remedial legislation designed for consumers to correct lender errors after the transaction is consummated. When there is a dispute about whether an action rises to violation, TILA requires that the law be interpreted in favor of the consumer. Liability will flow from even minute deviations from requirements of the statute. Technical or minor violations of TILA or Truth in Lending Act impose liability on the creditor and entitle the borrower to rescind. To ensure that the consumer is protected by TILA, it must be absolutely complied with and strictly enforced. Limitations. For mortgage purposes, Truth in Lending Act applies to loans on properties with 4 units or less, but includes transactions for individual condominium units, cooperative units, mobile homes, and trailers if used as a residence. TILA does not apply to business, commercial, agricultural, or organizational credit, which is investment purchases. Rather, investment purchases are also excluded. The right to rescind only applies to transactions secured by the borrower's principal dwelling and not loans used to purchase a property. Rescission is primarily available in refinances only. There is a 3-year statute of limitations, so if your loan closed over 3 years ago, this defense would not apply. Again, the right to rescind or rescission only applies to transactions secured by the borrower's principal dwelling and not loans used to purchase property. Rescission is primarily available in refinances only. There is a 3-year statute of limitations, so if your loan closed over 3 years ago, this defense would not apply. As soon as it is clear the borrower's right to rescission, a critical notice of the rescission is mailed to all lenders, assignees, and servicers immediately. Although the case law indicates filing a complaint is sufficient notice, indicating notice within an answer would suffice as notice. The author recommends taking the extra step as outlined here. So once again, as soon as it is as soon as it is clear the borrower has a right to rescind a transaction, the transaction, it is critical notice of the rescission is mailed to all lenders, assignees, and servicers immediately. An example notice is in Appendix A. The right to rescission ends when the creditor cures the violation, unless you already mailed the rescission notice, by providing new disclosures and permits. The 3 days to elapse, the property is sold, or 3 years expire. Again, the right to rescission ends when the creditor cures the violation, unless you already mailed the rescission notice, by providing new disclosures and permits. The 3 days to elapse, the property is sold, or 3 years expire. Rescission is effective when mailed. At least 2 courts have stated rescission is not necessarily automatic and may require a court ruling before the rescission is effective, such as would be the case in foreclosure action. We agree that a borrower's notice of intent to rescind his loan transaction does not in and of itself automatically void the transaction. Rather, a rescission occurs under 1635 either when the creditor acknowledges the consumer's right to rescind, or in a contested case such as this, when a court determines that the consumer is entitled to rescission. Yamamoto versus Bank of New York, and Bank of New York versus Jordan, 2007, Ohio 4293. Audit. Truth in Lending Act requires the disclosure of several pieces of information to the borrower at the time of closing. This information must be grouped together on one form. The Truth in Lending statement is used by most lenders and is easily identified by the 4 blocks of information at the top of the page as indicated in this image. Let's see if I can show this to you. All right. Back to our screen share. The finance charge defined. The finance charge is the dollar amount the credit will cost you. This chapter is dedicated to ensuring that number is accurate, because there are substantial benefits to the borrower if it is wrong by $35 or more. Again, repeating, the finance charge is the dollar amount the credit will cost you. This chapter is dedicated to ensuring that number is accurate because there are substantial benefits to the borrower if it is wrong by $35 or more. The finance charge is an important figure in these calculations as the lender only has a $35 margin of error or faces potential rescission by the borrower up to 3 years after the closing. Again, the finance charge is an important figure in these calculations as the lender only has a $35 margin of error, or it faces potential rescission by the borrower up to the 3 years after closing. The finance charge is actually a total dollar amount of a number of smaller charges associated with the loan. Federal law specifies a number of different fees and loan costs that must be included in the calculation of finance charge. Federal law also specifies which fees may be excluded from this calculation. Although the law specifies many costs, there are gray areas that developed over time with respect to some of the fees. These include how excess title insurance premiums, yield spread premiums, and inflated credit report or notarizing fees are factored into the finance charge. In calculating the finance charge associated with the loan in foreclosure, paying close attention to the calculations and individual fees are important. You will need to compare the settlement statement with the worksheets below in order to ascertain the real finance charge associated with your loan. The key here is to find at least $35 in fees that should have been disclosed in the truth in lending, but were not. Once again, in calculating the finance charge associated with the loan in foreclosure, paying close attention to the calculations and individual fees are important. You will need to compare the settlement statement with the worksheets below in order to ascertain the real finance charge associated with your loan. The key here is to find at least $35 that should have been disclosed in the truth in lending, but were not. What to include as a finance charge? There is an extensive spreadsheet towards the end of this chapter that describes line by line what should be included in any finance charge calculation. It includes the corresponding federal law for each line for ease of reference. Some of the fees in the spreadsheet do not have to be included in the finance charge calculation. While these are not included on their face, some further investigation will be needed to determine the full extent of their exclusion from the list. The following subsections highlight this need. If the charge could go either way, case law supports narrowly reading the regulation in favor of consumers to ensure proper disclosure of the costs of credit. Again, if the charge could go either way, case law supports narrowly reading the regulation in favor of consumers to ensure proper disclosure of the costs of credit. Title insurance premiums, only those bona fide and reasonable. Title insurance premiums are excluded from the finance charge calculation only if they are bona fide and reasonable. Some courts have found this means the rates charged should not exceed those prescribed under state law, especially with respect to any manuals of title insurance. In Oscar versus Bank 1, 2006, in Oscar, the court looked at the Manual of Title Insurance Rating Bureau of Pennsylvania to determine the maximum title insurance rates permitted under Pennsylvania law. The court determined failing to provide the refinance rates, which are cheaper than the purchase rates, in a refinance was beyond the reasonable title insurance amounts that would be excluded from finance charges. It found the excess over the reasonable or bona fide amount of these fees should be treated as part of the finance charge. Yield spread premiums, YSP, not finance charge. Yield spread premium is a bonus paid to a broker when it originates a loan at an interest rate higher than the minimum interest rate approved by the lender for a particular loan. The lender then rewards the broker by paying it a percentage of the yield spread, that is, the difference between the interest rate specified by the lender and the actual interest rate set by the broker at the time of origination, multiplied by the amount of the loan. Again, yield spread premium is a bonus paid to a broker when it originates a loan at an interest rate higher than the minimum interest rate approved by the lender for a particular loan. The lender then rewards the broker by paying it a percentage of the yield spread, that is, the difference between the interest rate specified by the lender and the actual interest rate set by the broker at the time of origination, multiplied by the amount of the loan. Oscar case continues, quote, while the yield spread premium, or YSP, is a finance charge, the Federal Reserve Board has concluded that it should not be disclosed as a prepaid finance charge pursuant to 15 U.S.C. 1605A6 because it is already included in the interest rate. Quoting, fees paid by the funding party to a broker as a yield spread premium that are already included in the finance charge, either as interests or as points, should not be double counted. Each of the Federal Circuit courts have held the same. Save for the Sixth Circuit, that has not yet faced the question. Thus, yield spread premiums should not be included in the finance charge when doing finance charge calculations. Credit report courier fees. The credit report and courier fees are only excluded up to the actual cost of each. If the lender or broker inflates these charges on the settlement statement, which is very common, then the amount in excess of the actual amount must be disclosed as a finance charge. For example, a $15 credit report may be showing a cost of $55 on the HUD-1 settlement statement. This $40 difference would need to be disclosed as part of the finance charge. Again, the credit report and courier fees are only excluded up to the actual cost of each. If the lender or broker inflates these charges on the settlement statement, which is very common, then the amount in excess of the actual amount must be disclosed as a finance charge. For example, a $15 credit report may be showing a cost of $55 on the HUD-1 or HUD-1 settlement statement. This $40 difference would need to be disclosed as part of the finance charge. Notary fees. Like their credit report and courier fees, the notary fees may not be in excess of the actual cost of the notary. Check your state's maximum permitted fee and add an excess beyond that fee to the finance charge calculations. In 2003, Pennsylvania limited the fee to $2 under 57 Pennsylvania Statute 167. California is limited to $10 for each signature taken under California Civil Code 8211. Appraisals. Check the HUD-1 settlement statement to see if the appraisal was paid directly to an appraiser or if the funds went to the mortgage broker for distribution. This number could be inflated and needs to be included in the finance charge. Also, check to see if the appraisal is an update from a previous appraisal completed several months earlier in refinance transactions. Was the amount charged reasonable if it was redone by the same company? Finally, check to see if the appraisal was an interior or exterior appraisal. That is, did anyone go inside the property or was it a, quote, drive-by? If it was just a drive-by, exterior-only appraisal, check the customary fees to ensure you were not charged for a full interior appraisal. Multiple insurance policies. Truth in Lending Act states that homeowners may choose their own insurance agent, and then that dollar amount does not need to be included in the finance charge. Additionally, the lender may sell you an insurance policy from their agent, but they must disclose certain things to the homeowner in writing to exclude the fee from the finance charge. If the lender sells the policy and does not provide the necessary disclosures, then the charge must be included in the finance charge. The necessary disclosures for lender-directed homeowners insurance are as follows. 2, Premiums for insurance against loss of or damage to property or against liability arising out of the ownership or use of property may be excluded from the finance charge if the following conditions are met. 1, the insurance coverage must be obtained from a person of the consumer's choice, and this fact is disclosed. 2, if the coverage is obtained from or through the creditor, the premium for the initial term of insurance coverage shall be disclosed. If the term of insurance is less than the term of the transaction, the term of insurance shall also be disclosed. The premium may be disclosed on a unit cost basis only in open-end credit transactions. Closed-end credit transactions by mail or telephone under 226.17G U.S. Code, and certain closed-end credit transactions involving an insurance plan that limits the total amount of indebtedness subject to coverage. I'm just going to bounce back to emphasize here that Truth in Lending Act states that the homeowner may choose their own insurance agent, and then that dollar amount does not need to be included in the finance charge. Additionally, the lender may sell you an insurance policy from their agent, but they must disclose certain things to the homeowner in writing to exclude the fee from the finance charge. If the lender sells the policy and does not provide the necessary disclosures, then the charge must be included in the finance charge. And remember, if it deviates by $35, you may have a rescission case. The necessary disclosures for lender-directed home insurance are as follows, which we just read through. Please note that these disclosures only kick in if the policy was sold to the homeowner at closing. If the lender later decides to force place insurance, that would not be a finance charge problem, although it may raise other legal claims like breach of contract. Document preparation. RESPA, R-E-S-P-A, prohibits any service provider from charging for preparing the Truth in Lending Act and RESPA documents. Therefore, charges for document prep that include the preparation of these documents are not bona fide charges and must be included in the finance charge. The entire charge does not need to be provided, just that portion of the charge that went to the preparation of Truth in Lending Act and RESPA documents. Potential recovery. A Truth in Lending Act violation may be brought against a lender at any time as a defense to collecting the debt, offset, including the foreclosure action. But there is a 1-year statute of limitations if seeking to bring an independent Truth in Lending Act action outside of foreclosure. A borrower facing foreclosure has special rights and can rescind the transaction up to 3 years after the loan is closed if material disclosures are not provided, including the misrepresentation of the finance charge beyond $35. Again, this is under potential recovery. A TILA violation may be brought against the lender at any time as a defense to collecting the debt or offset, including the foreclosure action, but there is a 1-year statute of limitations if seeking to bring an independent TILA action outside of foreclosure. A borrower facing foreclosure has special rights and can rescind the transaction up to 3 years after the loan is closed if material disclosures are not provided, including the misrepresentation of the finance charge beyond $35. If multiple loan transactions are involved and interrelated, the borrower should be permitted to rescind both transactions. For a loan where a mortgage broker fee was not included in the finance charge, this law has a unique provision whereby rescission is possible and all of the aforementioned damages are triggered if any mortgage broker fee was not included in the closing documents as a finance charge. However, this remedy is only available if the property is currently in foreclosure. Again, for a loan where a mortgage broker fee was not included in the finance charge, this law has a unique provision whereby rescission is possible and all of the aforementioned damages are triggered if any mortgage broker fee was not included in the closing documents as a finance charge. However, this remedy is only available if the property is currently in foreclosure. The author would expect that this would most likely occur when a mortgage broker fails to report in the HUD settlement statement, the HUD-1 settlement statement, a fee the borrower paid directly to it earlier in the transaction, like an application fee. Look for old canceled checks from the borrower to establish a fee was not included in the HUD-1 settlement statement. Alternatively, if the broker received a kickback from the title company in exchange for sending it business, this might be a fee subject to this regulation. Again, the author would expect that this would most likely occur when a mortgage broker fails to report in the HUD-1 settlement statement a fee the borrower paid directly to it earlier in the transaction, like an application fee. Look for old canceled checks from the borrower to establish a fee was not included in the HUD-1 settlement statement. Alternatively, if the broker received a kickback from title company in exchange for sending a business, this might be a fee subject to this regulation. An application fee paid to the broker must be disclosed in the finance charge unless that application fee is charged to every applicant who applies for credit with that broker, whether or not credit is extended. The author would note that in today's mortgage marketplace, it is near impossible to charge such a fee to every applicant, especially if credit is not. So you will likely find every mortgage fee needs to be in the finance charge. Again, an application fee paid to the broker must be disclosed in the finance charge unless that application fee is charged to every applicant who applies for credit with that broker, whether or not credit is extended. In today's mortgage marketplace, it is near impossible to charge such a fee to every applicant, especially if credit is not extended. So you will likely find every mortgage fee needs to be in the finance charge. And again, if it's off by $35, you can claim rescission. When the finance charge is understated by $35 or more, if the finance charge was understated by more than $35, then a borrower fighting foreclosure might be able to rescind. Check out 12 CFR 226.23 H2I and 15 USC 1635I. If rescission is available, all of the following layers of relief kick in. A right to immediately rescind the transaction, a refund of all principal and interest payment made to the lender, a refund of all closing costs paid at the time of closing, a refund of any down payment made in connection with the loan, termination of the mortgage, keep the property if you have already paid it off, and a borrower able to rescind the loan is able to also secure damages for general Truth in Lending Act violations as described in the next chapter. In addition to rescission, the lender is also liable for statutory damages as set forth below. An equal amount to the sum of the greater of one, any actual damage sustained by such a person as a result of the failure to comply, and two, not less than $200 or greater than $2,000 if the home loan is not a home equity loan. And 3, costs of the action together with reasonable attorney's fees. A Truth in Lending Act violation may be brought against a lender at any time as a defense to collecting the debt, including foreclosure. However, there is a 1-year statute of limitations if seeking to bring an independent Truth in Lending Act action outside of the foreclosure process. The lender must act within 20 days after receipt of the notice of rescission to effect the rescission, or the borrower may keep the property without further obligations. Wow. Listen up. The lender must act within 20 days after receipt of the notice of rescission to effect the rescission, or the borrower may keep the property without further obligation. That's why you send notarized letters that are dated and notarized, and you send it with signature, signature guarantee. Pay that extra for the postage so that you have proof that they received your letter. And after 20 days, if they do not respond, you are able to keep the property without further obligation. Look into 15 United States Code 1635, Section B. Okay. Strategy. For a loan used in a refinance, the benefit to having a Truth in Lending Act violation is in rescission. In other transactions, violations of the finance charge may go to establish a continual pattern of bad dealing by the lender. Pay attention to the 3-year statute of limitations as it begins to run with the consummation of the transaction or the closing. Applicable law or civil rule. Truth in Lending Act is located at 15 United States Code, Section 1601. The Truth in Lending Act is implemented by regulation according to the Board of Governors of the Federal Reserve System. The board has issued several regulations, including Regulation Z, which implements Truth in Lending Act for homeowners. Regulation Z begins at 12 CFR Section 226. Rescission is not a common law remedy. It is a statutory remedy, which means the law prescribes rescission when a violation is found. Again, rescission is not a common law remedy. It is a statutory remedy, which means the law prescribes rescission when a violation is found. Supplement I to Regulation Z provides definitions and additional information on how Regulation Z is implemented. This is part of Regulation Z and is definitive as to Regulation Z's meaning and purpose. Now, know the HUD-1 settlement statement. The HUD-1 is the document that contains the charges that must be included in the finance charge. This is where our analysis begins. The HUD settlement statement has 2 pages, with the second page looking like the image below. Let me go ahead and share that with you. Okay, hold on here. Are we seeing this? Okay. That's what the HUD-1 financing statement looks like on page 2. The The HUD1 settlement statement has 2 pages, with the second page looking like the image below. In a purchase transaction, this page will have 2 columns, while a refinance will only have 1 column. The 700 series goes to pay the real estate agents involved with the transaction. Generally, the 800 series block are fees that go to the broker, lender, and appraiser. The 900 series is for prepaid interest, while the 1000 block contains room for escrow accounts. The 1100 and 1200 blocks are used for title company charges, while any charges in the 1300 to 1400 blocks, sometimes with addendums attached, represent extra fees associated with the loan. So, and again, going down that list, that column, it's separated by series of hundreds. The 700 series goes to pay the real estate agents involved with the transaction. Generally, the 800 series block are fees that go to the broker, lender, and appraiser. The 900 series is for prepaid interest, while the 1000 block contains room for escrow accounts. The 1100, 1200 blocks are used for title company charges, while any charges in the 1300 or 1400 blocks represent extra fees associated with the loan. Elements. To rescind the transaction for a violation of 15 United States Code section 1635, that is for improper disclosure of the finance charge in a foreclosure action, a borrower must demonstrate these elements. Essentially, these are the things, these are the proofs that must be furnished. They are called elements. You must meet all the elements of the case to prove your case. So the first, number 1, the property subject to the loan is used as the principal dwelling of the person to whom the credit is extended. 2, the loan was not used to purchase or construct the property subject to the loan. That is in the property, remember. 3, the loan was a refinance of a previous loan, either A, held by a different lender than the original, that is the borrower switched lenders, or B, the borrower refinanced with the original lender and took cash out of the property. So again, one of the elements that you must demonstrate, number 3, is that the loan was a refinance of a previous loan, either held by a different lender than the original, or the borrower refinanced with the original lender and took cash out of the property. It has not been 3 years since the loan's closing date. And 5, one of the following apply. The loan is currently in foreclosure, and any mortgage broker fee was not included in the finance charge. Again, one of the following must apply. A, the loan is currently in foreclosure and any mortgage broker fee was not included in the finance charge. B, the loan is currently in foreclosure and the finance charge was understated by more than $35. Subsection 1, use the following worksheet to determine if $35 has been exceeded. Remember to look for charges paid to the broker or lender that may be inflated. Seek invoices and receipts during discovery. Or C, a material disclosure was not provided to the borrower. These include 1, disclosing the correct APR. 2, disclosing the correct finance charge. 3, disclosing the total payments. 4, disclosing the payment schedule. 5, disclosing the existence of a variable rate feature if applicable. 6, disclosing the necessary information with respect to the notice of the right to rescind. And then finally, D. Remember, one of these four must apply. So here's the fourth, D, that the loan is not in foreclosure and the finance charge exceeds 0.50% of the loan amount or $100, whichever is greater. Subsection 1, must be a refinance with the new lender or the same lender with cash out to borrower. Truth in Lending Act Rescission Worksheet. What is my loan's real finance charge? 1, transfer all fees from the HUD-1 settlement statement to the finance charge worksheet on the next few pages. Pay close attention to those fees that may be inflated, as described earlier. A, note, you may get help from the title company's closing instructions that break down the specific charges for you. Look for a statement that has the closing charges split into two groups. The top group will likely be the figures included in the finance charge. This form is not always included. 2, start by filling out the following spreadsheet, which are all the fees that are not included in the APR. Go line by line on your settlement statement and move each of the fees into this spreadsheet. Notice the appraisal and credit report fees go in the spreadsheet and are not finance charges unless inflated. Subsection A, only include those fees listed on the second and third page of the HUD-1 if you have a third page, in the column labeled paid from borrower's funds at settlement. Do not include those fees located on the first page. Subsection B. Note that most fees have standard names, although your lender may use a variation on the HUD-1, HUD-1 settlement statement. This is normal. Keep these rules in mind when deciding whether to put a fee in the finance charge. Subsection 1. Most mortgage broker and lenders' fees will be included in the finance charge. Subsection 2. About half of the title company charges are included in the finance charge. Subsection 3. Appraisal, credit report, flood insurance, and other third-party fees are generally not included in the finance charge. And then 4. None of the real estate agent fees are included in the finance charge. Before going through the work on the following worksheets, check to make sure this defense applies in your situation. First off, ask yourself, is the property subject to the loan used as the principal dwelling of the person to whom it is extended? Your answer must be yes. Has it been less than 3 years since the loan's closing date? Your answer must be yes. Was the loan used to purchase the property? Must be no. Okay. Now we're going to go to a section that is called fees that should not be included in the finance charge. We're going to kind of rip through these rather quickly. Abstract of title, application fee, if charged to everyone who applies. Again, these are fees that should not be included in the finance charge, where we're looking to see if there's a $35 deviation. Abstract of title, bona fide and reasonable. Application fee, if charged to everyone who applies. Appraisal fees, if performed pre-close. Remember to get the invoice. Credit report fees, get the invoice. Debt cancellation coverage not included in APR so long as consumer is told in writing, not required by the creditor, the fee or premium is disclosed and consumer signs or initials in the affirmative his understanding of such. Deed preparation should not be included in the finance charge. Flood determination or monitoring fees should be no more than about $35. Real estate agent fees should not be in the finance charge. EPA or other type of endorsements, bona fide and reasonable, usually about $75 each. Homeowners insurance includes insurance imposed by lender so long as lender discloses coverage can be obtained from someone of his choosing and premium for initial term is disclosed. Also, what should not be included in the finance charge are insurance premiums for voluntary credit, life, accident, health, loss of income, if disclosed in writing that these are not mandatory and told the amount of premiums and sign a statement. If disclosure, do not count in APR. Loan preparation, actually preparing the document. Mortgage preparation, actually preparing the document. Notary fees, check your state maximums. Property inspection fees, if performed pre-close. Property taxes, or escrow amounts. Note, if there is an aggregate adjustment in line 1011, subtract the adjustment from the taxes amount before placing in this column. Property survey, bona fide and reasonable. Reconveyance preparation. Seller's points paid. Settlement doc preparation. Similar purposes, bona fide and reasonable. Streamlined valuation fee if bona fide property appraisal related. Tax escrow amounts. Recording fees, which are taxes actually paid to officials for determining the existence of or for perfecting, releasing, or satisfying a security instrument. If there's any credit back to the borrower, subtract that credit from the cost. Taxes on security instruments. Title examination, bona fide and reasonable, and title insurance, bona fide and reasonable. Check to see if the refinance rate was issued. So add up all your total fees not in APR. Let's get back and see if we can determine what the APR is again. Okay. After you have entered all of the fees not included in the APR, then complete the following checklist by moving over all of the fees that are included in the APR. And here's that list. These are fees that should be included in the finance charge that is paid by the borrower. Administration fee, amortization schedule fee, any fees in excess of those actual costs, appraisal desk review, assignment recording fee to the lender, assumption fee, attorney fee, broker loan discount fee, broker origination fee, broker underwriting fee, buy down fee paid by borrower, closing agent courier fee, closing agent fee, closing fee for settlement or settlement fee, closing fee to lender or broker, commitment fee, condo or homeowner association approval fee, construction administration fee, courier fee by title company, credit report fee in excess of actual cost, desktop underwriter fee, discount fee or loan discount fee, document preparation fee, escrow fee, escrow holdback administration fee, escrow waiver fee, fax fee by title company, FHA MIP impounds, FHL MC REO delivery fee, funding fee, inspection fees, interest prepaid, jumbo pool fee, lender courier fee, lender origination fee, lender underwriting fee, lender's attorney fee, lender's inspection fee, loan discount, loan fee, loan origination fee, lock-in fee, master service administration fee, MERS fee, miscellaneous broker lender fees not included in the yield spread premium, mortgage insurance, MI or PMI fees, mortgage insurance impounds or PMI impounds, mortgage insurance premium and impound cushion, mortgage insurance premium or PMI premium, NCHFA processing fee, other service-related fees, plan review fee, prepaid interest, processing fee paid to a third party, processing fee to bond authority, recording fees not to tax recording authority, redraw fee, RHS guarantee fee, settlement fee, shipping and handling, signing fee, statement fee, sub-escrow by title company to pay off existing liens on loan, subordination fee, subtitle fee, supplemental origination fee, table funding fee, tax service or tax contract fee, title binder fee, title examination, which is excess beyond bona fide and reasonable, title insurance endorsements, excess beyond bona fide and reasonable, transfer fee, if paid to lender or broker, underwriting fee, VA funding fee, verification of deposit fee, verification of employment fee, VHDA bond loan fee, warehouse fee, wire fee to lender, and wire transfer fee. Then add in any fees the borrower paid in cash to the mortgage broker, like any application fees. And then add the numbers for total fees that are included in the APR. Next, state the amount of fees that you think are questionable. Next, state your grand total of finance charge fees here. Then, turn to the truth in lending disclosure statement provided at closing and copy the information from the table into this grid and do the following multiplication. Number of payments, example 364 times whatever. Amount of payments, $700 equals, and then your total paid. Multiply the number of payments by the amount of payments. Next, state the total amount of all payments, then restate the number, which is your grand total of finance charge fees. State the total amount of the loan. Subtract the number of your total amount of the loan from the total amount of all payments. And then add in the grand total finance charges. And this is likely your loan's real finance charge. Just verify the questionable charges. Next, do some comparisons. A, compare this dollar amount to the amount disclosed in the finance charge located in the truth in lending disclosure statement provided at closing. That is the finance charge box. Compare this dollar amount to the amount disclosed in the finance charge box located in the truth in lending disclosure statement provided at closing. If your real finance charge more than the amount disclosed in the finance charge box by at least $35, rather, is your real finance charge more than the amount disclosed in the finance charge box by at least $35? If so, you may have finance charges that were not included within the finance charge and the loan may be rescindable. If the numbers are the same, then look to see if any of the fees stated in the settlement statement were inflated. If you can locate at least $35 in inflated fees, The excesses must have been disclosed as part of the finance charge. If they were not disclosed, the loan may be rescindable. And then finally, if any of the inflated amounts went to the mortgage broker, the loan may be rescindable even if the dollar amount was under $35. So I know this is a lot to take in, but hopefully this information will help save people in a desperate position. I just had to take a little water break. We'll be continuing on here in just a minute. Okay. The Truth in Lending Act Rescission Checklist. Complete the proceeding before completing the checklist. Okay. Is the property subject to the loan used as the principal dwelling of the person to whom credit is extended? Your answer must be yes. It has not been 3 years since the loan's closing date. Your answer must be yes. The loan was not used to purchase the property. Is the property in foreclosure? If no, were all the material disclosures provided? These include disclosing the APR, disclosing the correct finance charge, disclosing the total payments, disclosing the payment schedule, disclosing the existence of a variable rate feature if applicable. Is the property in foreclosure? If yes, continue with this checklist. Did the mortgage broker charge any fee that was paid in cash by the borrower and not disclosed on the HUD? To avoid the application fee being included in the finance charge, every person walking into their office, whether or not credit was granted, would have needed to be charged the same fee. Check to see if a copy of the credit report is enclosed in the loan file and whether or not it has a price on it. Price on the credit report is what? The amount charged on the settlement statement is what? Amount borrower was overcharged to be added to the finance charge. How much? Next, state your tax maximum charge for notary services. State the amount charged on the settlement statement for notary services, and then state the difference between the charges to be added to the finance charge. Next, state the amount charged on the settlement statement for the appraisal. State the amount actually charged for the appraisal. Look for the invoice. State the difference between the charges to be added to the finance charge. State the amount charged on the settlement statement for the courier fee. Let me repeat. State the amount charged on the settlement statement for the courier fee. State the amount actually charged for the courier fee. Look for invoice or obtain a copy from the title company by subpoena. Or state the difference between the charges to be added to the finance charge. Then, state this state's maximum permitted title insurance charge for this loan amount at the full purchase rates. Then, if this transaction was a refinance, state the maximum permitted title insurance charge for a reissue refinance rate. State the title insurance premium charged for this loan located at the settlement statement. If the amount charged in this loan was in excess of the maximum permitted, state how much should be added to the finance charge. Then, complete the What is my loan's real finance charge worksheet preceding this checklist. Then, transfer all charges listed in the loan's settlement statement to the spreadsheet below. State the real finance charge here Add any finance charge amounts left out for inflated credit reports, notary services, and title insurance. The total real finance charge is what? The difference between the real finance charge and the finance charge listed on the truth in lending statement is how much? Is it over $35? Understating the finance charge is by this amount is grounds for rescission. Again, understating the finance charge is by this amount. I think that's a typo. Understating the finance charge by this amount is grounds for rescission. Checklist for rescission if a mortgage lender, rather if a mortgage broker was involved in the transaction. Was the credit report fee exaggerated, not included in the finance charge, and paid to the mortgage broker? Was any other fee exaggerated, not included in the finance charge, and paid to the mortgage broker? Ask the borrower if he or she paid any fee to the broker that was not disclosed at closing. Get cancel checks if possible. Then, ask the borrower if the broker kept any of the loan proceedings after closing. Get canceled checks, subpoena the canceled checks from the title agency or bank. Next, check to see if any mortgage broker's fee was charged but not included in the finance charge. Rescission is possible for missing even $1, but the loan must be in foreclosure. Rescission is only available for 3 years after the date of closing. Was there a broker and realtor involved and possibly any kickbacks paid to the mortgage broker? And then finally, state laws may also afford rescission to the borrower in addition to Truth in Lending Act. And Truth in Lending Act permits states to do so. Moving on now to defenses. Affirmative defenses. Properly included as an affirmative defense and survives even when counterclaim dismissed. Add these affirmative defenses to your answer under the affirmative defenses section. See Appendix D. Use paragraph numbers where indicated. Let's see. So where it says properly included as an affirmative defense and survives even when counterclaim is dismissed. Footnote says, quote, "We first addressed the bank's argument that Jordan cannot argue rescission because the trial court dismissed her counterclaims, which included a claim for damages under 1640 as a sanction for her failure to comply with its discovery order. We note that although Jordan's counterclaims were dismissed, she also asserted rescission as an affirmative defense. Those defenses remain valid even after the dismissal of her counterclaims. Accordingly, although Jordan is precluded from pursuing any claim for damages based upon her right to rescind, she is entitled to assert rescission as an affirmative defense to the bank's foreclosure action." Let's see. The mortgage and note are void. Here's another affirmative defense. The mortgage and note are void for lack of compliance with the Truth in Lending Act. 15 United States Code, Section 1601, Regulation Z, and then 12 CFR, Section 226-1. Again, the mortgage and note are void for lack of compliance with the Truth in Lending Act. And then another affirmative defense, the defendant is entitled to and hereby exercises his or her right to rescind the loan transaction for lack of compliance with the Truth in Lending Act, 15 U.S.C. Section 1601 and 12 CFR Section 226. Starter discovery, interrogatories. Add these interrogatories to your request for interrogatory responses form. See Appendix J. Use paragraph numbers where indicated. State the method the finance charge was calculated. State each charge on the settlement statement that was included in the finance charge. State each charge on the settlement statement that was not included in the finance charge. So an interrogatory is basically when you send questions to the defendant, okay? You're the plaintiff, you're making the case, and you're seeking to gain remedy, and the defendant would be the lender who, who lent out the money for the mortgage loan. So during the interrogatory phase, that's when you, the plaintiff, who are initiating the lawsuit, are able to send them questions which they are then required to answer in writing. So those would be the three questions. State the method of the finance charge. State the method the finance charge was calculated. State each charge on the settlement statement that was included in the finance charge. And state each charge on the settlement statement that was not included in the finance charge. Requests for admission. Add these requests to your requests for admissions form. See Appendix H. Use paragraph numbers where indicated. Admit the name of fee charge was not included in the finance charge. Admit the, whatever the fee, the name of the fee. Admit that fee. Admit the name of fee charge should have been included in the finance charge. Admit the finance charge is understated by at least $35. Admit the name of fee charge was paid to the mortgage broker in this transaction. Admit the defendant has a statutory right to rescind the loan transaction under the Truth in Lending Act, 15 U.S.C. United States Code 1601 and Regulation Z, and 12 CFR 226.1. Okay, so in this case, they're describing you as the defendant. So, okay, so if this is, I guess, in foreclosure, if the lender has initiated a foreclosure case, they then stand as the plaintiff, and you are the defendant, but you can still send these questions during the interrogatory phase to get them questioned, and these requests for admission as well, asking them to admit about these charges, to admit the truth, basically to testify in writing. And then also requests for the production of documents. Get absolutely every invoice for every fee charged on the settlement statement that you can locate. Subpoena the entire mortgage record from the mortgage broker involved in the transaction, as well as the title company and real estate. See Appendix K. If you can locate the name of the appraiser or credit bureau retailer for this transaction, subpoena all of their records for the transaction. The idea is to obtain every document possible and to look for inconsistencies. Make sure all fees are accurately reflected on the settlement statement and that there were no upcharges, especially on the appraisal, title, notary, and courier. A request for production to the lender might look like this. See the form in Appendix 1. Provide a copy of the invoice for the property appraisal. Again, these are more for requests for the production of documents you're requesting to them. Provide a copy of the invoice for the property appraisal completed on such and such date, and provide a copy of the invoice for the credit report dated on such and such a date. Counterclaims. Because there are statutory damages associated with the rescission, you may choose to include a counterclaim seeking payment of those damages. Okay, count 1. Defendant, you. Defendant alleges the mortgage, deed of trust, and note are void for lack of compliance with the Truth in Lending Act. U.S. Code 15, Section 1601, Regulation Z, and 12 CFR Section 226.1. Defendant alleges that he or she is entitled to rescind the loan transaction for lack of compliance with the Truth in Lending Act. 15 U.S.C. Section 1601 and 12 CFR Section 226-1. Defendant alleges plaintiff is liable to him or her in an amount equal to the sum of however many dollars, which represents defendant's actual damages sustained as a result of the failure to comply with the Truth in Lending Act, 15 United States Code, Section 1601, and Regulation Z, and 12 CFR, Section 226.1. Defendant alleges plaintiff is liable to him or her in an amount of $2,000 for statutory damages under the Truth in Lending Act, 15 U.S.C. 1601, and Regulation Z, 12 CFR 226.1. Third-party claims. Rescission is brought against the holder of the loan as assignee. Rescission is brought against the holder of the loan. The holder, as assignee, is liable for the rescission. Thus, no third-party claim is necessary to rescind. An action against a third party for damages under the Truth in Lending Act sections discussed in this chapter must be brought in 1 year. And bonus, for an extra spin on the Truth in Lending rescission, several courts have determined that the borrower's right to rescind survives a refinance. That is, even though the lender no longer has a security interest in the loan, the borrower may still rescind the loan. The Sixth Circuit says it the best. No doubt, the imposition of a security interest as part of the loan transaction is necessary for the right of rescission to attach to a transaction. What, in the words of the regulations, quote, gives rise to the right, 12 CFR 226.23, 12 CFR 226, Section 1, and 226.23. See also 15 United States Code, Section 1635, subsection A. But neither the Act nor the regulations say that the right persists only as long as the security interest does, and of course, the right applies to the transaction, not just the security interest. Nor does the Ninth Circuit's decision in King versus California in 1986 prompt us to reach a different conclusion. The entirety of King's analysis on the point is this: the loan of March 1981 cannot be rescinded because there is nothing to rescind. King refinanced that loan in November 1981, and the deed of trust underlying the March 1981 loan has been superseded. Not only does King, of course, not bind us, but it does not address the provisions of the Truth in Lending Act that undermine its conclusion. Only one other court of appeals, to our knowledge, has considered the issue. In an equally brief and unpublished analysis, the D.C. Circuit offered this drive-by rejection of the King approach. Quote, "We disagree with the creditor's contention that the refinancing of the 1994 loan rendered unavailable the Act's statutory rescission remedy, notwithstanding the Ninth Circuit's terse suggestion to the contrary in King." And that's from Duran versus First Government Mortgage and Investors Corporation from the year 2000. Quote, "Some district courts, it is true, have followed King. See, for example, Jenkins versus Mercantile Mortgage from 2002. If a loan has been paid off, there is nothing to rescind because the mortgage that the plaintiff wants rescinded has been released and no longer exists. There is nothing to rescind because the mortgage they want rescinded has been released and no longer exists." And finally, most district courts, however, have not. See McIntosh versus Irwin Union Bank and Trust, 2003. Quote, "This court rejects the argument that it should apply King. As several courts have noted, a serious flaw in King's approach is that the implementing regulations of the Truth in Lending Act never state that paying off a loan in full cuts off unexpired rescission rights." King reaches its conclusion without the analysis that we believe that this issue deserves. Given that the Truth in Lending Act is to be favorably construed toward borrowers, and that provisions such as 15 USC section 1635D and 12 CFR 226.23E limit a borrower's ability to waive his rescission rights, the loss of a borrower's ability to rescind a loan transaction that has later been refinanced due solely to refinancing is questionable. Given the absence of analysis by the Ninth Circuit in King, this court agrees with the courts which have held refinancing does not bar a suit for rescission. The King's Court conclusion, however, is at odds with the Truth in Lending Act and its regulations. Finding unpersuasive the lender's argument that because a loan was paid in full as a result of a later refinancing, the lender could have done nothing in response to the debtor's demand for rescission of the refinanced loan. The bank finally complains that this approach will allow borrowers to avoid any period of repose by simply contriving a colorable notice issue that could give rise to the right to rescind. Financial institutions, according to the bank, could be forced to defend a rescission claim long after the transaction is finished. But the same is already true if the borrower chooses not to refinance the loan. Under those circumstances, all agree, the borrower has 3 years in which to rescind the transaction. If, as alleged here, the bank failed to satisfy the notice requirements of the Act. The statute itself, in other words, describes the rules for repose: 3 days if the bank satisfies its disclosure requirements, and 3 years if it does not. To the extent banks wish to avoid a 3-year window for bringing rescission claims, the Act offers them a fail-safe way for doing so: satisfy the disclosure requirements. When there is a failure to make all material disclosures, the consumer has a continuing right of rescission. Again, it's from Davis, Cox versus First National Bank of Cincinnati, 1985, and Davis versus Federal Deposit Insurance Company, 1980. When there is a failure to make all material disclosures, the consumer has a continuing right of rescission. The borrower's right of rescission under 1635A and F continues for more than 3 days after the extension of credit only if the lender has failed to make material disclosures required under this part, and continues for up to 3 years only so long as the lender fails to make such material disclosures. When the creditor fails to disclose any item of the requisite information, the right to rescind is not limited by the normal 3-day period, but continues until all the disclosures are made or the right expires. Nor has the bank supplied us with any indication that the numerous district court decisions embracing this approach have prompted a flood of rescission claims premised on a colorable notice of issue. So, my friends, that is it for this first video in a series of foreclosure defenses, this being defense number 1, the Truth in Lending Act. Our next video in the series will be entitled Truth in Lending Act Violations for Damages. So until then, thank you so much for spending your time with us, and have a wonderful day. Walk in honor, exercise your rights, and enjoy your freedom.